Hi guys and welcome. On this video, we're going to discuss about assumable mortgage. How does it work? What are the pros and cons of this type of mortgage? And which things you should know before applying? Let's start. So what is an assumable mortgage? When you're looking to buy a house, it's going to cost you a lot of money, and that means you're going to need to pay attention to how you can afford it. For most people, affording a house means that they need to go to a bank and get what's called a mortgage. On the other hand, that traditional mortgage is not the only thing you can do. You can also get what's called an assumable mortgage. That means the home buyer gets to take over the current mortgage that the seller already has. Of course, the lender needs to agree to this. One of the best reasons to go for this type of mortgage is if interest rates have risen since the time that the original mortgage was taken out. In this case, the buyer is able to get all of the benefits of that mortgage. After all, higher interest rates means higher cost when it comes to borrowing. When the buyer is able to take over the current mortgage, they're going to save more money on payments. Unfortunately, that means the full cost is not covered with the mortgage, and there may be a requirement for additional down payment or financing to cover the purchase price. Let's say a seller has a current mortgage of $200,000, but their house is selling for $270,000. In that case, the buyer is only going to be able to assume the $200,000 mortgage, but they need to come up with another $70,000 to buy the house. That could mean an additional mortgage or new financing at the current interest. Also, even though the mortgage is being assumed, that doesn't mean that the lender can't make at least a few changes to the current rules of the loan. The credit of the buyer and the market conditions in the area will play a part in this. Back in the 70s and 80s, these types of mortgages were actually extremely popular, but they've lost a little of their popularity over the years. Part of the reason is that there are now tighter regulations and economical changes. Still, there are plenty of situations where you can get one, and they happen a lot with FHA loans and VA loans. The buyer must be assuming a federally guaranteed or insured mortgage. So, you may be able to assume FHA loans, insured by the Federal Housing Administration, VA loans, insured by the Department of Veterans Affairs, even if the buyer is neither a veteran nor a member of the military, USDA loans, insured by the Department of Agriculture. Now, let's review the things you need to know about assumable mortgage. For many people, this type of mortgage makes sense because it gives you several benefits, but there are things you should take a closer look at. Of course, you need to pay attention to the type of mortgage you're getting and the interest rates as well as what you're going to need to do in order to get the rest of the money. But take a look at these things as well. Evaluate the details. Don't just take the seller's word that you can assume the mortgage they have or how much they owe. You want to make sure you get a copy of all the information, including a copy of the mortgage and the beneficiary statement. Look at how much the difference is between what's owed and what you can do to pay that money. Rates for interest. You're going to want to look closely at what the loan rates are. If the rate right now is higher than what the loan has, then you're going to save a great deal of money. In fact, if you can get an interest rate of 5% instead of 7%, you could save $257 a month, which is going to be a lot of money over a period of several years. Fees. When it comes to TRID requirements, which are mandated by the federal government, there are specific rules required. One of those is that borrowers are required to receive a loan estimate from the lender. This explains the costs that are going to happen when it comes to taking over the mortgage. There are going to be a lot of fees associated, but in general, the fees will be more when it comes to getting a new loan instead of taking over the original. You could end up with a huge difference of several $1,000s. Make sure your statement includes things like fees for application, credit report fees, appraisal fees, prepaid interest charge, underwriting fees. You must get approval. You don't get to just assume a mortgage whenever you want. You still have to be approved for the loan by the lender, just like if it was a brand new mortgage. If the lender doesn't approve, then you're not going to get the loan. This also means you have to use the same mortgage company that the original borrower used. On the other hand, you're generally not going to be required to get a new appraisal. That means you'll have an easier time closing the deal, and you're going to save a little on fees since you don't have to pay this one. You can still get an appraisal if you want to, though, to make sure that you're not paying more than the property is worth. Make sure also that you have an idea of the equity on the loan, which is the part you'll need as an independent loan or a down payment. Release of liability. When you start looking at this type of mortgage, however, it's important that you make sure everything is done correctly. If it isn't, the seller could actually still be held responsible for the mortgage. That would mean that if the buyer defaulted, the lender could actually go after the seller to get their money. Make sure that you're following through on all the paperwork and that you're getting a release from the lender that proves you are no longer responsible for the mortgage in any way. Assumable mortgage has a couple of advantages. The truth is, it's not just the buyer that's going to get a lot of benefits with this type of mortgage. A seller can actually get some benefits as well. That's especially true if the interest rate that's currently on the loan is actually lower than what the buyer would get with a new loan. Think about it. If the current rate is 7% and the old loan is at 5%, that means the buyer is saving hundreds of dollars every month. Next, there aren't going to be as many closing costs, which benefits the buyer because it saves money. It also benefits the seller because they can likely get a better deal with the buyer for the purchase price. What's really great for everyone is that when you assume a mortgage, it's a very simple process. A lot easier than getting a whole new mortgage. And that means there's less time involved, and there's not a requirement for a property appraisal either. All of that is going to make things a whole lot easier to get through. When it comes to the seller, they actually have an upper hand on the market. Not just any mortgage can be assumed, but with benefits that come along with it, that could be an asset. It could make a homeowner more interested in buying the house. On the other hand, you should always consider the drawbacks. As with anything, there will be situations where this isn't the best option. For a buyer, it's important to look at the purchase price versus the amount of the mortgage. Is there going to be a down payment or some type of financing required outside of the assumable mortgage? The $200,000 house we talked about earlier, with the $270,000 purchase price, is one example. The buyer would need to come up with $70,000 in cash or additional financing in order to buy the house. That extra money could be at a much higher interest rate than the mortgage. A second loan generally means a second mortgage company, and that could make it difficult to get everything sorted out. The two companies may not want to communicate with each other, or they might be reluctant to take on this kind of arrangement. For the buyer, it becomes more of a hassle and not so much of a benefit anymore. When it comes to the seller, there's always the possibility of being held liable for a mortgage that has already been passed over to someone else. If the buyer defaults, it could come back on the seller, and that's definitely not something they want to deal with. Getting a written copy of the release of liability from the mortgage is essential to prevent this. Finally, you should know that Federal Housing Administration loans and Veterans Affairs loans can be assumed, but most conventional loans can't. On the bottom line, when it comes down to it, it's entirely possible that an assumable mortgage will be the best option for you. It's all going to depend on interest rates and the type of mortgage that you're getting, as well as how much the purchase price is versus the assumed mortgage cost. Just make sure you talk with the lender and see if everything is going to work out best for you this way. That's it for now. On our website, you can find more posts as well as calculators and other financial tools. Considering an assumable mortgage? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel to get the best financial videos for free.